Egie, it's great to have you on the show today.
Yeah,
and
hi,
maybe
Wole.
we should talk a bit about, it's a shortened week, but I think the big discussion point is the flows we're seeing into the bond market from offshore and the impact that is having on our yields here.
Yes, obviously since Monday last week when news filtered out about some Nigerian bonds being added to the JP Morgan emerging market government bond index,
Right.
we've seen a significant move in yields. Yields have dropped significantly since then, probably 50 to 80 basis points across the board.
Right. Well, that's definitely significant. And the big question for me, maybe before we get to the T-bill market, is to what extent do you think this will impact activities in the subnational and corporate issuing space? Because we've seen very little activity in that space this year.
Well, I mean, unfortunately, that index is strictly for the national index for the countries profiled by JP Morgan. So it doesn't go down to the subnational level. So subnational bonds here are not included. But the indirect impact for the subnational and corporate issuers is really that the benchmark from which they list their price their bond, which is the federal government index, federal government bond rates has dropped.
Right.
So anybody coming to the market immediately now will be having to pay significantly less than they would have done a month ago.
Well, very significant. But do you think there will be enough appetite at these levels, or do you think those yields still have to come down a little bit more?
Well, I think the challenge obviously is that it takes a while to put together a corporate or state bond issue, which is why we always advise our clients to be to go into the process and be ready to pull the trigger when market conditions are right.
Right.
Market conditions now are better than a month or two ago, and so for those issuers who are on standby, it's the time to go in. Whether they need rates to be lower, everybody always prefers to have lower rates, but how much lower they can go from here on the short term is open to debate.
Well, of course, one of the things that are driving yields lower is the strong demand we're seeing from foreign investors. I want to get your views on where you see that going, the implications of this JP Morgan index decision to add Nigerian bonds into that index. Your thoughts on where this dynamic is going to play, how it's going to play out for the markets going forward? Well,
I think, one thing to bear in mind is that, the index, from what we understand, has about 170 billion tracking that is built around that index. So the impact to Nigeria is about $1 billion. And at some point, that $1 billion of foreign buying would have been done.
Right.
I don't know if there's any exact way to measure it. We've heard different numbers, like 200 million as of last week.
Right.
The launch date for Nigeria going into the index is October 1.
Right.
So between beginning of last week and October 1, that 1 billion or so of bonds has to be acquired.
Right.
But there's no way to tell when that acquisition will be done. And at some point when that buying is done, and all you have is marginal buying as the size of the index changes,
yeah.
You are going to see rates going back to where they came from, unless some other factor keeps them down at this level.
Right, but so if you're a trader, how do you play this now? You're suggesting that rates may come down for a while and then bounce back up. So is this more of like a speculative opportunity for bond traders for you, or do you think we should simply be positioning into, say, the longer end of the curve?
Well, it's always very hard to predict this thing because within this market, there are other local variables that do impact these rates. But if you look at what happened last year, when the one-year holding period was lifted, there's a significant move in yields. Yields probably went down about 1%.
Right.
When that initial rush had died down, they went back up. So if nothing else fundamentally changes in the system, there's a significant chance that we'll be seeing rates creep up again post-October 1.
All right, let's touch the T-bill market. And we know that foreign investors were very aggressive about that space until recently. We're hearing that they are now moving into the longer end of the curve, buying bonds. We did see that T-bill auction this week. Your thoughts on the results we saw?
Well, I think that T-bill auction obviously came at an interesting time on a Wednesday. I think bids had to be in Wednesday morning after the two-day public holiday. So obviously some things were out of sync. I mean, the federal government money, the allocation started to come in from early this week, late last week. And if you look at the results of that auction, clearly there was a lot of demand at 182 days. There was no 364-day on offer, with a subscription of 90 billion, with only 20 billion being offered, excluding the unsolicited bids. And the yield on the 182 days came out about 16.3. But right now, that bond is that instrument is trading around 14 or just below. So clearly, that auction was the high point of the week. And since all the money has come into the system now, yields have gone substantially lower.
Right. Okay, well, thank you so much, Egie, and do enjoy your weekend. It's great to speak to you. We look forward to speaking to you again sometime.